Hey everyone, so this is Addy again. Today I'm talking about Nasdaq 100 futures. Here's a quick explanation. The final goal of this video is to teach you how to trade a credit spread in Nasdaq 100 futures. Now, what is Nasdaq 100? It's the it's the index that tracks the technology sector. It's made up of 100 top tech companies, and there are futures that are traded on this index as well. Now, this is how the futures work. The name of that feature is E-mini Nasdaq 100. It's obviously a CME product, the Chicago Mercantile Exchange product. The ticker is /NQ. Then there is a mini version of this, which is called /MNQ. But we're not discussing that right now. We're discussing the main contract, which is the /NQ contract. The multiplier of this contract is $20. Um, and the minimum price move is 5 per index point, meaning 0. So this basically moves 0.25 index points times a multiplier of 20. So it moves in $5 increments. So if the index value goes up 5 points, your P&L will be those 5 points times $5, $25. Each index point, whichever way the index moves, each tick is basically $5. Now, what's the initial margin to trade a futures contract? It's roughly around 5% right now. I did this slide a couple of hours ago. That's when the NQ price was trading at 19,591, and I just saw that it is now trading slightly higher, or slightly lower, I guess. The current notional is basically you multiply the current price, which is 19,591.75 times the multiplier of the index, which is $20. So here, the total notional of this contract is 391,835. However, when you trade futures, you do not put the whole amount down. You only put a certain percentage of it. So right now, that percentage is around 5 to 6%. This margin balance, it depends on market volatility, span margining. There's multiple other various factors that go into determining the dollar amount of this margin or the percentage. Currently, that margin is sitting as 21,000. So, meaning if you want to trade a futures contract, if you want to buy the current front month contract, which is the U contract, the September contract, you go to this ask price. This is the limit price here. If you confirm and send, it's currently trading at 23,000. When I did the slide, it was around 21,000. And then you pay some cost, some trading commissions, like $2.25 to get in, $2.25 to get out. That's how you trade an outright futures contract. If you want to short the future, you basically go in the bid, and the sell side comes up. The red side is the sell side. Again, once you hit confirm and send, you will pay down $23,100 to initiate this contract. And then for the rest of the life of this contract, the margining will depend on how volatile this product is, how volatile the overall market is, and most importantly, how far out the contract is, meaning how many days are left in expiration of this contract. Currently, the front month is expiring in 24 days. That is September 2024. There are four expiration cycles that are listed in all major indices: S&P 500, Nasdaq, Russell, and Dow Jones, which are the quarterly expiration cycles: September, March, and June. Then you go down, you get September 25, December 25, and then they list one additional December contract further out. But if you see the volume in these contracts, there's nothing going on. There's no volume. The only number that you can see in the volume column is in the front month. And I will show you how to look at the option chain and how to set up this trade. Now, it was important to understand how the contract works. Basically, you can trade this contract 23 hours a day, Sunday to Friday. So the market opens on Sunday afternoon, 3 p.m. Pacific till 2 p.m. Pacific. Um, Friday 2 p.m. Pacific, with a daily maintenance period of 2 to 3 p.m. Pacific time. Now, once we understand this basic mechanics of the contract, here's how you set up a futures options trade. Now, this is my paper trading account. I do all my testings here. So if you do want to put a contract on, if you do want to test the markets, I recommend you use the paper trading account. Set it up with your broker. I would recommend using TOS. It's the best options trading platform out there. No matter what people say, I've been trading these things for the last 8-9 years. This is the best thing I've ever seen. Anyway, let's get back into. First of all, I want to show this. Look at this. This is a very important column. Both of these are volume and open interest. See how much open interest there is. Nasdaq futures are not as liquid as the S&P 500 futures. Now, if you want to do a comparison, let's go to the S&P 500 futures, S&P 500, and then let's go down. I was in the 52 days out expiration cycle. I'm going to do the same thing here. And look at the difference here. There's thousands of these, hundreds of thousands of these open interest contracts. Now, what is open interest? Meaning there are this many open interests. This many contracts. 16,993 contracts open at this strike on the put side. 4,800 strike. Now, each contract, as we discussed, each futures contract, as we discussed, is again a 50 multiplier works on the S&P 500 times the current price is 56.41 is worth $282,000 each contract. Now these are options open interest numbers. If you want to see the actual futures volume, I was trying to bring in the open interest column here, but I just could not. I'm pretty sure I've seen it. I just wasn't able to bring it up here. I don't know how to change this to bring up the open interest side. Anyway, let's get back to our Nasdaq futures here. So now, let's say if I was going to trade this, first of all, I'd go and look up the chart. Right, volatility is a very important metric here because we are volatility sellers. Option sellers are by default short vol. Currently around 20. If I have to draw up a line for year to date, this was that big Monday morning move when everything moved down quite a bit. That yen carry trade, fiasco, whatever it was. And then since then, the volatility has tamed down. It's come down to its normal level of 20 for the year. This is a year-to-date chart, 1 year, 1 day chart. So look, if I was to take a trade here, the market has gone up quite a bit. Now in the past, I have sold calls on these indices, and trust me, selling calls is a pain in the backside because the market is so bullish. 70 to 80% of the time, the market goes up. If you look at the history, and I'm doing some research on it, I'll show you. Just running some last 10, 20 years, 30 years data on it. 70% of the time, the market is in the up move direction. 10% of the time, it doesn't move at all. 20% of the time, it goes down. So here, the market has gone up quite a bit, and it has found resistance at 20,000 level. So I think it will keep on either move up a little bit from here, or stay around this level, or maybe come down a little bit, but not too much. Because the rate cuts are coming in September, middle of September. So the idea is to stay where the market is and take a little bit of an up move here. Anyway, this is a paper trading account. If I was to take this trade in my real account, I would wait for some sort of a market direction because I'm a contrarian trader. So I sell calls when the market goes up, in commodities especially, not indices, and I sell puts when the markets go down and everything else. So I'm just careful with these indices the overall market indices, selling calls is a tough thing to do because the markets are so bullish. Anyway, selling puts is the best thing to do out there because the market are so bullish. Anyway, let's set up a put trade. My go-to strike, first of all, days to expiration. Now, if I close this down, I want to be in a gray expiration cycle, which is the monthlies. Right now, I also want to show you guys here. Look at these symbols here, NQU24. All these options are basically underlying the September future. If you ever get assigned on these options, you will be given a future to hold, and the future settles into the index. So they're all basically the same thing. The futures settle into the index, the options settle into the future. On expiration, they will all settle to one price. That's it. That's all you want to know. There's nothing more complicated about this. Options, futures, index, whatever. They all settle into one price on expiration. Anyway, next thing, look at these NQs. I'm talking about these numbers here, NQs, NQ24s. And then it changes here after 24 days. So this cycle then is now underlying the NQZ contract, which is the December one, which is 115 days off from now. Anyway, what I'm trying to show is I'm going to stay in this one, NQZ24, which is 52 days out, and we will take a position in this cycle. Again, it's a paper trading account, it's not my real account, so it's best for practice. This thing is the best thing for practicing. Anyway, the fills are not real. I mean, whatever price you give it, it will most probably fill into that price. So it's not real, but it's good to learn all these strategies, how to set up, how to manage. The next thing is my go-to is the 17 delta. I like this spot here. That's my go-to starting point, always. 17 deltas is where my short strike will be. Well, again, you can't always get 17 deltas. Sometimes it's 18, sometimes it's 19, sometimes it's 20. If I have to go below 17, I think 16 is my max. I don't ever go 15 because then I don't get enough credit. So you have to make sure you're getting good reward for your risk that you're taking. So let's set up a trade. I'm going to right click on the bid side because I'm selling it. I'm going to sell this thing into a vertical. This thing needs to change to one. Always start with one contract, and I'm fine with taking 50. So I do take in the Nasdaq. I would take 50 points out. So the short and the long strikes will be, will have a width of 50 index points. So that's what this is set up as. $6.25 is a good credit that I'm getting. Now I'm going to go into the Analyze tab. And then I will try and analyze this trade by selecting the right strike prices. Selecting the right expiration cycle, which is 1019. Make sure 1019 is selected here as well, which it is, or 18, whichever one. Open this up a little bit, move the chart around, just to make sure that you're seeing the whole thing. Now, the first thing I look at on this chart is this number on top here. 82% probability that this underlying index will stay within the shaded area, and if it does, we make money. We want this thing to either go higher or stay around here or come lower. Lower is fine too, but do not fall below our break even. But even if it does, we have mechanical adjustment techniques that we are going to use to manage the trades. That's why these are high probability, high success trades. We sell options because one more thing I want to show you is if you want to see the actual probability of success of the out of the money options, take a look at this thing. Customize this thing and bring in probability of in the money. Now, what does this show us? probability of in the money shows what is the probability of this option contract to be in the money on expiration, like this option contract to be in the money. It goes hand in hand with the deltas. So if you look at these deltas here, we are within 16, 17 deltas. That's how much, that's what the probability is of this option to be in the money if you buy it right now, for this option to be in the money at expiration, right? It goes hand in hand with deltas here. So 16%. Now we are selling this option, meaning we have 80, whatever 100 minus 16.84 is, that's our probability of winning this trade. If you go down here, you will just see it all goes hand in hand with the deltas. Slightly here and there, but this is what the deltas are. That's what the delta show us. 17 deltas mean it has got a 17% chance of coming in the money at expiration. It has 100 minus 17 is what your probability is of winning, and that's what you see on the Analyze tab, that your probability is really high, around 83%, right? That's 100 minus 17 almost. So you go hand in hand with what the delta was showing. Anyway, this is the trade I like. This is how much this is what I set it up as. So here, so our max credit is basically $6.20. It says $6.25, and you have to divide that number by 5 to get $6.25 to get your actual max profit. So in terms of dollar amounts, these are index points. In terms of dollar amounts, you will collect $125 in this trade, and your max loss is $875. Obviously, you never go to max loss, right? We manage our trades at a certain level, meaning if my overall P&L in this trade is below, or is negative 100%, or negative 125, or negative 150%, then I will look to adjust this trade. Otherwise, I will not touch it. That's the rule of the thumb. That's how we stay mechanical in these trades. Meaning, I'm collecting $125. My total P&L has to be 125 times 1.25. So unless I see a negative P&L of 156 in this trade, or let's say $100, negative P&L of $100 or 125, that's when I will look to adjust this trade. 100% is when I start thinking about adjusting, and 125 to 130 to 140% negative is when I actually adjust. Anyway, so we know exactly what we're doing. We know our probabilities. We know how much of a chance we have to win this trade. There are a lot of other things that I want to show you. Like let's talk about deltas here, right? Greeks. How many deltas are you collecting? 12 deltas. These are in futures terms, so you're collecting 12 deltas. You're in zero gamma. You are slightly positive theta because it's a positive theta trade. Short options are always positive theta, and you're in negative theta, meaning you are expecting volatility to either stay around this mark or go down a little bit. Fine. The next time I will show you how if you change the volatility numbers, this P&L will change either in your favor or against you. The next most important thing is to check how much money are you putting down to trade this. $225, and there's a $4.50 fee that you pay in to get in, and you pay to get out. Fine. You have to pay these charges, and then we will look to. But look at the ROI here. Let's say this thing comes in. This thing makes you money in the next few days. Let's say you collect $75 out of the 125 max. You've paid down $225 here. Your ROI is basically 33%. Now the exact return on investment, or what do you call it, a holding period return, meaning how many days were you in the trade for, and how much money did you put down? That thing is different. We will do that later. But this is back at the envelope math. 33%. You have a potential of making at least 15 to 20%, 25% in this trade. Anyway, I'm just going to go ahead and put this trade in. See if it gets filled. Markets are running right now. They are open. Yes, and I did get a fill. And the fill was at 625. Like I said, this is a paper trading account, so the fills are not real. I could have changed the price and then I would have still gotten in. I just want to show you the strategy of managing the trade now. How am I going to manage this trade? That's the key point. That's the key question. Let's say the market goes down on us. We are sitting at 18,300 short strike. The market comes down from almost 19,600 to, let's say, it's 19,600. And then it comes down to, I don't know, maybe let's say 19,000, right? It loses 600 points. It loses 600 points, sitting at 19,000. We are short put, meaning we are long the market, so it has to go up or stay here. Anyway, and then the market is sitting at 30 deltas for us. Now our short strike has gone down, the market has gone down, and it's sitting at 30 deltas. We started at 17. What I'm going to do is then go onto the call side, select the 30 delta strike, the one that has more volume and open interest. That's the one I'm going to select, which right now seems like 20,500. Fine. And I'm going to sell a vertical on the call side. Right. Now what this does, it gives you more credit. So now keep in mind, this is showing me a 1,000 wide strike, which I don't want. I want a 50 point wide strike, which are not available here up until unless I go down to 40 deltas. I will do that right now just to show you, but in reality, when this thing comes closer to expiration, they will open up more $50 strikes here. You can see they have it here. If you go further out, they have some like 750 to 800, 700 to 750. We just don't have it at this level, which is fine. We can sell the 25 deltas. Yeah, we have a $50 wide, 50 point wide strike here. Now the way I picked that up was because I was getting too much credit, and then the wider you go, more credit you collect. So I'm going 700 to 750. Yep, that's $50. I'm still getting a lot of credit here, $13.50. Maybe the market's closed and the marks are not right. That's what my only guess is. Usually you will collect $6.75, $7 credit, which will eventually turn into 150, 175 max. This thing is giving me $13.50. It looks a little unreal to me, but maybe that's what the market is. These looks like bad marks, by the way. But anyway, the risk management technique is to collect more credit, widen out your break-even points. So when you collect more credit, this break-even point is going to go further back for you, because now you've collected more credit. If there are more than 22, 25 days left in this cycle, more than that, if there are around 30 to 35 days, then I will look to adjust this trade or spread in this current expiration cycle. Otherwise, I will look to move this spread into the next cycle. That's the key question here. Like, do you want to stay in this cycle? Well, if there aren't enough days left, because we don't trade in the last 15 to 20 days because the short gamma hurts the position too much. It's not worth taking that risk. So we would like to move the spread, the whole thing, into this cycle, and then sit on it, look at it, and then make the adjustments there. Now, the way I trade, look, the shaded area shows where this underlying index will be between now and expiration at these given current volatility numbers. This is mainly driven by volatility right now. So the volatility is very calm. The index is going to stay very calm. And we are expecting to make some money out of this. We know how to adjust. We know what to do when the trade goes bad. That's why when you buy options, you have no option to adjust. But when you sell these options, you always have an option to do something. You either sell it You either convert this into an iron condo, or you take the whole spread out and move it into another cycle and you collect more credit. You readjust your strikes, and then you basically wait for the market to come back to you. Um, Again, like I said, there's a big positive drift in the market 70% of the time. So it's really good when you sell put options. When the market goes down, and you know if the market has gone down for sorry, some stupid reason, always look to sell options, because the volatility is now has jumped up, meaning you will get more and more premiums. And then once volatility comes back down to normal, you will make money out of the gate, because your options are going to be worth less than what you actually sold it for. So you will buy back cheaper. Anyway, this is the trade, Nasdaq futures. Let me know if you have any questions. Just one last thing here. We are running a free options trading cohort, which is happening on September 13th at 2:30 p.m. Go take a look at this link, thelongshortidea.com/cohort, and then sign up there. I am basically going to teach all of these things in that free 1 hour and 30-minute session. Go take a look. If this makes sense to you, if this is something you want to learn, I recommend signing up, because I'm not going to be doing the next one free. This is my first one, so I'm testing the markets. I have a lot of knowledge about these things. This was just to test the market to see if people respond to my queries, and they have. We have almost 100 people signed up so far, and my max capacity is I think 150. So that's where I get maxed out. So go there, sign up, and then follow the channel, because I'm going to post this video on YouTube. Follow the channel, and then look at other videos too. Thank you very much. Bye bye.